live from CNBC TV18's headquarters in Mumbai. This is Opening Bell with Udayan and Mithali Mukherjee.
Good morning. Welcome to Morning Call. Quite a punch for the market yesterday, a bit of a knockout. So many important levels for the Nifty were violated after that Reserve Bank communication yesterday. And this morning the environment for risk assets isn't great. Commodities have sold off. Asian markets are looking a little weakish. So if this morning we were hoping for some lift from the global space, that has not happened. So let's see whether the Nifty can stabilize, because it's fallen quite a bit over the last few days, or there is more downside even in the near term before things stabilize somewhat. Mithali, good morning.
Hi, good morning. Yesterday was nasty for sure.
It was coming for a long time. You can't say that you could not see the signs for this kind of damage coming. It needed a catalyst, and maybe the Reserve Bank provided the catalyst yesterday, speaking about growth having to be scaled down. So then I think the penny dropped, because the market has been ignoring so many of the bad bits of news which have been floating around, maybe a bit surprisingly too, over the last few weeks, that maybe it required a little bit of tough talk to have the penny drop, and it did certainly drop yesterday. So I think this was probably overdue, but too many straws were piling up on the camel's back. Now the key question to ask is whether this is just a correction and we'll pass through over the next few days and weeks, or whether the intermediate uptrend which started from the day of the budget, which took the market from 53 to 59.50, that in some way is breaking down, leading to some intermediate weakness or intermediate downtrend just for the next few weeks. I think we saw some evidence of that yesterday, and the bears certainly came back into the game, as you saw, with a huge amount of shorting. So I guess in the next few days you'll get a clearer answer to whether we are now in some kind of a downtrend for the next few days.
For the policy itself as well, there will probably be some soul searching for the market, and generally for economists on everything it had to say.
Yes, the one thing which came away, aside of the many downgrades, etc., which happened, is that a lot of people who were quite bullish about India's GDP, regardless of the macro headwinds which were piling up, have started scaling back their GDP forecast. So now I saw a lot of the brokerages, the Morgans, the Merrills of the world, now pretty much in that 7.5 to 7.8% GDP growth target for the year. Now that's not horrible, that's not a howler, but it's a bit lower than what people were expecting. I think it also follows, though people are reluctant to make those earnings downgrades yet, that earnings will also get scaled down through the July quarter. Some will happen over the next few weeks, I guess. Others will follow probably at the end of the June quarter results. So you'll see a few markdowns which inevitably follow GDP downgrades. So it's tough to say how much more there is to go on the interest rate cycle. I think it's fair to admit for most people that they have been calling this inflation cycle a little incorrectly, and maybe the interest rate cycle therefore. So there is a bit more of tightening to come, a little bit more bad news on the growth front to surface. So I think we need to just wade through over the next 2 or 3 months of a not so benign kind of a news flow period on the economic front. It will improve, but next 2-3 months, and we have been in a fairly soft patch in terms of macro. But sometimes markets play tricks on your mind. So you look at the screen and say 5900, and then you say, okay, things are not too bad. But when it's 5500, then you start feeling, okay, things are bad. So once stripped of the screen, things have been bad. They will continue to be bad for a bit longer, but then will improve. So I guess next 2 or 3 months is when serious investors should be looking to buy.
Keeping the levels people are beginning to talk about again on the index are that 52-53 zone again.
Yeah, that is inevitable, Mithali, after 57 and 5600 broke. So now I think people will start talking about 53 and 5400. So that is just extrapolation, so don't read too much into it. But having said that, some important levels have been broken yesterday. As we've discussed for the last 1 week, I think the traders' confidence in buying the dip from 5900, or every dip from 5900, has got violated. So now I think the orientation of the market, or for the trader, has changed once again. If in the last 1 month it was buy every 100-200 point dip in the Nifty and try and ride it back to 6,000 levels, I think after yesterday's move that has changed around a little bit. Having said that, the fall over the last few days has been quite sharp. I think from 5900 plus to 5560 is in a short span of time, relatively short span of time, 300-350 points on the Nifty. So if we start weak and at some point get close to 5500 levels today, you would have fallen 7-8% very quickly on the trot, and that may mean that the stage is getting set for an oversold technical bounce. It's very difficult to map these bounces because they are against the grain or against the run of play, if you will. So that can happen anytime. It can happen today intraday, it can happen tomorrow, but you'll probably get one of these pullbacks which might then get capped around that 5700 level, which the market took a long time to break. So that probably will act as some degree of resistance from here on. So it's difficult to say where we go in the next few days because technicals are not very supportive after yesterday's breach. You will get a bounce almost inevitably over the next few days, but I think it's easier to talk about, just for the moment, a 5400 to 5700 kind of trading range from a 57 to 5950 that we had been in. So I think we've gone down a step. Now we need to readjust, take stock of the situation, maybe consolidate in a lower band, and then see if there is even greater momentum on the way down to get to the levels that you've been speaking about. But the orientation has changed from a trading perspective, and that's an important change to take stock, to take note of.
As it has for the flows, I mean, the way the cash market and futures market saw outflows yesterday was pretty sharp.
Yeah, we've been talking about this shorting from the Nifty futures for a few days now. Yesterday's figure was 1600 crores on the Nifty futures, which makes you, which gives you greater confidence to talk about that pullback, because now I think in 3 days or 4 days you've added close to $800 million of Nifty shorts. At some point, for whatever reason, profits will be taken there. You will see a little bit of a pullback therefore for the market, but the cash market selling is getting relentless and it's picking up. And yesterday on such an eventful day, you saw 1200 crores of Nifty cash market selling, cash market selling from FIIs, and that tells you that in addition to whatever emerging market view they're taking, they are getting a bit worried about what's going on with Indian interest rates, growth, etc. And it's no coincidence that FI selling has picked up over the last few days leading up to the monetary policy. So that becomes a very important thing to monitor, because, you know, like it or not, that sets the prices for our market. If you look at the options data, that too yesterday gave you a signal that the way 5700 calls were being written and 5300 puts also, I think it's the smart money telling you that that probably is your range for the moment, and the market might find it a bit tough to climb above 5700 just in the near term. Also, volatility has picked up a little bit from here on. So let's see. I mean, to answer your question, you said 5300, and that's the budget day low. So is the clock going to be turned back to the budget day, which is pretty much where this last bit of the rally happened of 600 points on the Nifty?